It's Dennis Wilburn, the Active Trend Trader. As we wait for the Fed to report out tomorrow, we notice that the S&P has now joined the NASDAQ and the Russell in bear territory. Now it's just waiting on its cousin Dow to join it there also. But when will that be? What's going to take place? How are you protecting yourselves? How far will this market fall? Will the Fed action just result in one poking the bear and pissing him off so that we drop even more? We shall see. Let's go ahead and get into today's session right now. And here's what we're looking at. Basically, is just a reminder that all the materials we do present are for trading purposes. Traders should trade all new methods prior to the risk of their own personal capital. Past performance is not an indication of or a promise of future performance. So let's go ahead and jump into the charts. And the first thing I'm looking at is the Dow. Now, Dow, I don't normally go to the Dow, but the Dow we want to be taking a look at. It has now reached about 18% to the downside from the past highs from over here. So it's spitting distance away from moving into a bear market. What's the projected downside on this? Well, a couple of ways you can do that is we'll just do a very simple one first. We'll do a simple Fibonacci extension, go from this low to this high here, and then that gives us another projection down. A 100% projection of this move from this low to that high puts us down at about 27.99, or just say 28,000 for a projection on the downside. One of the things to keep in mind is what would happen. We would drop below, normally we don't pay a lot of attention to this, but it would drop below the 20-week moving average. And as we see there, oftentimes that is when that 20-week moving average breaks, that basically indicates we have a lot more downside to head on in the near future. So we'll look at that's a downside target right there, about 28,000. Somewhere in this area here might be a really good place for a relief rally, because the other thing that we have going on here, folks, is we are getting extended away from the 20-week moving average or 20-day moving average, which is, we just consider that the mean. Anticipate a rebound back up towards the mean. That's what we can be looking forward to, and then a reversal down from there. Some of the other questions that is how does this compare to what should we expect for a downside move? There's the bell, and we are, guess what, down for the day. Shock, shock. So let's take a look at the S&P. A couple of folks, economists and really good forecasters out there, are forecasting that the S&P between now and the middle of 2004 will be down 86%. 86%. Well, how far down is 86%? Let's take a real quick look at that. I'll go over to the monthly chart, because it gives us a better picture of this. An 86% move from the past high of this year would take us all the way down to, you ready for it? It would take us all the way down to the lows of 2008, the 2008 bear market. Remember, the 2008 bear market was a 57% drop. And so that's one of the areas. So 671 on the S&P. Wow. You think that could cause a lot of consternation out there. And we want to make sure that we're taking the steps to protect ourselves just in case that goes that way. Depending on where you're at life-wise and age-wise, that may be something you don't want to ride out. While it will provide wonderful opportunities, awesome wealth-building opportunities when this current bear market works its way out, it would be challenging to recover. If you're in your latter part of life, it's going to be hard to recover, because it took us to get a recovery back to just these levels here. Took about 5 to 6 years. Our system rolled us to cash, and we're sitting in cash right now. We're sitting in cash basically, and waiting for the Fed And we'll be looking at trading some of our inverse ETFs to the downside. So that's what we're looking at with that. So there's two different targets. One, the 86% downside target corresponds to 1929. The 57%, which is where? There's 54, there's 50, about 57, which is basically coincides with the bear market back in 2014, 2015. There's 57%, 2039. That corresponds to the bear market of 2007, 2008. And so, that's the one definitely that we would prefer. But the fact of the matter is what we want to be doing is trade the charts that are in front of you. And the other thing I want to be taking a look at is, and then we'll get over to the S&P. Matter of fact, I'll do this on the NASDAQ. Let's go over the NASDAQ NDX. And so what about the NASDAQ projection? I'm going to get rid of this real quick, remove that drawing. And I'm going to take this high to low and project it back to this swing high here to give me an idea of what the Fibonacci's are. And so right there, back to there. Now the Fibonacci start lining themselves up. The 50% retracement would be down here at the 11,011. A 100% move down would put us down at 91.24. I like to shift over to the monthlies to kind of give us the rest of the picture here. And as you can see, there's a 100% extension. And so what that means is it basically would be a symmetric move from this past move down. But then the 1272 is here. The 1618 is here. And then a complete move, well, this would be 223% here. And so those are good targets to the downside. That 618, look to your left, corresponds to where we basically had some basing in the past. Same thing, breakout area at the 8,071 level. And the way I'm going to be utilizing this information is to look at, these are areas where we could NASDAQ retrace back in 2000, back in here. Well, it went from this high to this low right there. That turned out to be 54%. Now, of course, the NASDAQ wasn't around at 1929. So again, are those, potential projections? You betcha. So keep those in mind. So I'm looking at the 100% move at 91.24, 1272 at 8,098, and then I'm looking right there at the 1618, 67.92 on the NASDAQ. What about the Russell? And we'll just do a straight projection off the Russell. Hold down to. And one of the, again, part of the things we'll do here is I'm going to grab this monthly, go ahead and take my fibs. I'm going to go from this high here down to this low. And I'm showing you different mechanism by which you can, in fact, do your downside projection. And believe it or not, we've already hit the, right there, that is the, there you go, the 100% extension, which corresponds with how much we dropped back in 2020 during the COVID bear. And so right there, we've hit that already. We're sitting right on top of about the 1709. Then look for next projection down, 1506. Next projection down, 127.42. Again, let's roll back out just a little bit here. What about that larger number, that 86? Let's take a look at Russell. How far did it drop back in 2007, 2008? From here down to here, and that corresponds to about 60%, a negative 60%. So in the ballpark of the fill 80, where would it take us? Go ahead and just jump up here, grab that 80%. Again, taking us right back towards that same level of the 2008 bottom. So there you have it. I wanted to cover that for you, give you some downside targets. Now, the other thing to remember in this whole, as we wait for the Fed, the other thing to remember is simply that some of the largest bull rallies have happened during a bear market. So that's something to look forward to. We have more tools to handle the bear market than we did even back in 2007. We have the inverse ETFs to be able to trade as the indexes are going down. Those inverse ETFs are going back up. And so that gives us a projection down to the downside. Look for the start of the reversions back to the mean. We're extended away from the 20-day moving average, and so expect a move back towards it. But I'll be using that move to set up a downside trade. So it's just basically reversing our thought process of handling bear flags rather than bull flags. So anyway, hope that helps. Hey, leave us a comment down in the comment section. And I would really appreciate, I don't ask for this very often, but I appreciate you doing 3 things for me. 1, subscribe to this channel, because basically that's what helps us reach more people. 2, like what you're, like or dislike, whichever, just say, hey, Dennis, you're full of crap. You don't know what you're talking about, but, my 30 years of experience, say something else. And then also just tell us what you think's going on with this market. Where do you think it's going to be midsection of mid-year 2024? So just remember, trade well, prosper, aloha, and God bless everybody.